We have reached the point where no discussion about the AI revolution is complete without discussing this big tech giant. Zuckerberg is perhaps the most committed to bringing about superintelligence, and he is sparing no expense in doing so. And yet another earnings blowout. Meta is proving it can basically mint money. And with that cash, it is dead set on acquiring the best AI talent in the world. Welcome to The Quality Investor. Love it or hate it, Meta and its flagship Facebook is becoming an earnings juggernaut. Facebook has faced quite a bit of criticism over the years, such as data privacy issues, misinformation, and free speech restrictions. The platform is a lightning rod. I personally haven't used Facebook in years, but what is harder to ignore is how solid of an investment Meta has become. Their family of apps now boasts nearly 3.5 billion daily active users, a 6% year-over-year increase, and that translates into some juicy ad revenue for Meta. And they're using their AI to tailor ads and recommendations, which Zuckerberg claims is already seeing a return on investment from their massive CapEx spend. And AI was the major theme on the earnings call. Meta highlighted that AI-driven improvements have led to 5% increase on ad conversions on Instagram and 3% on Facebook. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. They're also stating that Reality Labs, which hosts Meta's AI glasses, is gaining momentum, and revenue there was up 5% year over year. Zuckerberg emphasized the long-term vision for AI glasses as the ideal form factor for integrating superintelligence into daily life. But all of this AI potential monetization comes at a steep cost, mainly in the form of CapEx, but also in some other ways less discussed in the mainstream. Susan Li, Meta's CFO, acknowledged the potential for share dilution as Meta spends generously to hire AI talent, with 100 million plus signing bonuses and stock grants as the norm. Stock-based comp as a percent of free cash flow is now at over 34% on a trailing 12 basis, up from 31% at their fiscal 2024 year end. That is something to keep an eye on as an investor. But Meta does plan to offset that with share buybacks to minimize the impact. There must be caution there too, as buybacks are best done when the share price is considerably lower than what the company believes its intrinsic value to be. In Meta's case, many argue that $750 a share is a steep price right now. So the question we must ask is, what is a good share price to acquire Meta shares? Let's dive into the earnings report, discuss their plans for AI investment, and find out what a solid buy price is for this pillar of the Magnificent Seven. Meta is having a very good day today, up nearly 3% to $771.30. And this comes after soaring post-earnings over 10% the Thursday after they released their earnings. So Meta is definitely a stock that has been performing well. Year to date, more of the same. It is up over 28%. And with seemingly good reason. You can see that revenue year over year for their Q2 is up 22%. They've expanded their operating margin from 38% to 43%. They increased their earnings per share by a staggering 38% from $5.16 a share to $7.14 a share. And all this was driven by the increase in their daily active users. Of course, more eyeballs means more money for advertisers. 3.48 billion on average for June of 2025, an increase of 6% year over year. And ad impressions increased by 11% year over year. Of course, because Meta has such a large active user base, they have pricing power. And you can see that the average price per ad has increased 9% year over year. So Meta is executing on that front very, very well. And it's the investors who are reaping these rewards. And of course, their massive increase in earnings certainly translates to a massive increase in cash. We can see that the net operating cash flow was at $49.6 billion so far 6 months through the year to date of 2025, which is up from $38.6 billion 1 year ago. It's also important to note here that the share-based compensation it is up to nearly $9 billion through the first half of 2025, up from 8.18 through the first half of 2024. That's actually a 9.8% increase. So we're definitely seeing some early effects of these AI talent hires in the SBC, and it should become more pronounced throughout the rest of the year and into 2026, as employee compensation is the second largest driver of expense growth after their infrastructure, of course, due to adding technical talent in priority areas like AI. And this has actually led Meta to increase their total expense guidance on the low end from 113 to 114 billion for 2025. And they cited upward pressures on expenses from hiring of all the AI talent. It's also important to note that their R&D expense is also up 23% in Q2 of 2025, which actually grew a little bit faster than the revenue, and R&D, of course, is very AI heavy. So we're seeing the effect in the total operating expenses and the share-based compensation, but we're also seeing a large CapEx spend out of Meta, just like we are in the rest of the big tech world. But nearly 30 billion in CapEx through the first 6 months of 2025. That's up over double from the first half of 2024. They still expect the 2025 CapEx to land on the high end of their guidance range of 72 billion, but they narrowed the bottom end from 64 billion to 66 billion. So they are spending slightly more than what they expected on the low end. And of course, this is all in order to build out infrastructure to support the growing AI needs. And even for 2026, while they did not give an exact figure, they said that the infrastructure planning process remains highly dynamic, and we currently expect another year of similarly significant capital expenditures dollar growth in 2026 as we continue aggressively pushing opportunities to bring additional capacity online to meet needs of our artificial intelligence efforts. So we can see while gross margin has declined slightly, it's still at 82%. Operating margin has remained relatively flat over the last 10 years or so. It's now on a trailing 12 basis at 44%, and we could probably expect to see that maybe remain flat to compress slightly in the next couple of years as we see the elevated OPEX spend and even the CapEx spend in the form of depreciation start hitting the operating expenses. And we should expect to see free cash flow margins to remain depressed as well. However, I do expect free cash flow to grow slightly. And not only that, but to accelerate as we get more return on investment for the current CapEx spend. And we can see that despite a lot of outcry in the market a few years ago over Zuckerberg's virtual reality spending, that Facebook does a good job of allocating capital. You can see the ROIC here has steadily increased over the last 10 years. On a trailing 12 basis, it's at 30.57%, and ROCE sits at nearly 40%. So while we might get some dips here in the near term due to the elevated CapEx spend, Meta has a good history of generating a return on their investment, and we have no reason not to expect them to continue to generating a high ROIC. Looking at the estimates I have for the next 10 years, on a bear case for revenue, I have them growing at 11.3% per year. They're up to 14% on the bull case for that revenue. Operating margin I have on a bear case at 43% and on a bull case growing to 47%. Coming down to free cash flow margin, I had that at nearly 27.5% on the bear case by year 10 and potentially at 35.6% on the bull case by year 10 if they execute on everything. And on a PEG ratio basis, they're pretty modestly valued right now at a PEG ratio here of 1.94. Meta trading at $772.44. That has a PE ratio of 28, a forward PE of 28.3. Based on a reverse DCF, the market expects their free cash flow to grow at about 11.11% over the next 10 years. My base case has them growing at 12.05%. So we're pretty much in line there with the market. My bear case DCF has Meta at $695.38. $861.83 on the base case and $1,077.35 on the bull case. Now, Meta does pay a dividend discount, but is really skewing their valuation average downwards. So I decided to remove it and just look at the exit multiple, which is at $682.21. I'm using comps here of Google, Spotify, and Tencent Music Group. So you can see on the base and the bull case, there is some upside here. And without any margin of safety, they have a buy price of $806.94 and a forward PE of 29.6. With a 20% margin of safety, that's a buy price at $645.55. And I do think that Meta is a little bit overvalued right now. To give you some context, they have a 28 PE ratio, and Google has about a 20 to 21. PE ratio. However, I believe Google has a much better run rate for growth because Google is simply more diversified, and Google has something right now that Meta does not, and that's Google Cloud. And I think Google Cloud is going to provide massive upside potential for Google, whereas Meta right now is simply an advertising business. They make 99% of their revenue from advertising, and until they diversify into another business line that shows real growth potential, right now Reality Labs is tiny, it's hard for me to see why they're getting this PE ratio in the market. So while Meta has done very well for investors over the last year and even 3 years, I would not want to buy into this stock until it comes down below 650, maybe even into the low 600s before considering adding it to my portfolio. But at the end of the day, Meta is a business with very high margins. These margins will continue to grow, and they will continue to generate a good return on their capital in the medium to long term as their capex spending starts to bear fruit. But again, I think it's a bit overvalued at this current price, and I would certainly wait for it to come down quite a bit before adding shares to the portfolio.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.